Is now starting. All attendees are in listen-only mode.
Good day, friends and traders. My name is Tian Crick, and I'll be your host for today's UTP lesson on time frames. And today is Wednesday, the 29th of March, 2017. I've switched to a new headset, so I just want to make sure that audio and visual is perfect on my side as well as on your side. How's the sound? Okay, great stuff, great stuff. Thank you, everybody. Thank you, Dale. Thank you, Drew. Beautiful. Right. Now, today I'm going to discuss time frames, and I will also discuss chart relationships and push zones. Right. Now, larger time frames control the price movement of smaller time frames. Smaller time frames respond to the ABCDs of the larger time frames. Expect U-turns or trend reversals on the smaller time frames when C's and D's are hit on the larger time frame. Right. So here we have a larger time frame, A, B, C, D, and then we have a smaller time frame, A, B, C, D. Right. That's in a bull market. Here we have a bear market down, A, B, C, D on a higher time frame, and then inside the higher time frame we have smaller wave movements, and those will be the new down A, B, C, Ds. Right, and the market will typically hit a D extension on the smaller time frame when it hits a D extension on a larger time frame. Right, now have a look at this picture that we have here. This is a daily chart, and on the daily we have an up A, B, C, D swing. There we go. And now we have a 2-hour chart that we've compressed, and it looks exactly the same as the daily, but now we can see those ABCD wave movements more clearly. These are the ABCDs from the smaller time frame, A, B, C, D. And you can see the ABCD waves from the smaller time frame respond to the ABCDs from the larger time frame. Right. Dale says, Tian, I figured out the difference between managing my trades and fiddling with them. If you are losing pips, you are fiddling. There we go. Right, before we continue, is everybody with me up to this point? That in essence, the higher time frames will control the smaller time frames. And on the smaller time frame, you can clearly see the ABCDs as the market moves from either the A to the B or the B to the C or the B or the C to the D on the higher time frame. Okay, great stuff. Now we get to chart relationships. Now, due to larger time frames controlling the price movement of smaller time frames, there are key chart time frame relationships. Right. Andrew says, sorry Tian, still dropping out. Sound check icon at the top right of the GoToWebinar reports only a fair quality. It's normally higher than this, but it's not too bad. Okay, fair quality. I wonder, Andrew, if the issue is not on your side then, if everybody else is having a good sound quality from my side. Okay, Dale says it's still good here. All right, let's carry on. So we monitor the ABCDs on larger time frames, and then we trade smaller time frames. So if you're looking at a monthly chart, then you should be trading a weekly chart. If you are looking at a weekly chart, then you should be trading a daily chart. If you're looking at a daily chart, you should be looking for a signal on a 2-hour chart. And if you're trading looking at a 4-hour chart, you should be trading a 60-minute chart. And if you're trading a 2-hour chart, you should be, or if you're looking at a 2-hour chart, then you should be looking for that signal on a 15-minute chart, and a 1-hour chart is related to a 5-minute chart. Andrew says, Andrew's got a very good internet connection. I wouldn't know then, Andrew. I wouldn't know. If the problem is on my side, then I do apologize, but it seems to be okay. Right, now the average distance of the push zone between a C to a D and an uptrend or a downtrend on various time frames. On a 15-minute chart, the push zone from a C to a D is about 45 pips. And on a 30-minute chart, it's 90 pips. On a 60-minute chart, it's 180 pips. On a 2-hour chart, it's 240 pips. On a 4-hour chart, it's 300 pips. On an 8-hour chart, it's 420 pips. On a daily chart, 600. On a weekly chart, 1,500. And on the monthly chart, it's 2,400. Now just note, the distances between the C to the D will depend on the average daily trading range. The smaller the daily trading range, the smaller the distance between the C to the D. The larger the daily trading range, the larger the distance between the C to the D. For instance, the distance between the C to the D on the euro pound will be much less than, for instance, on the pound Australian dollar. All right, because the pound Australian dollar has got a much higher daily trading range than the euro pound. Right, let me just make that a little bit bigger. There we go. Each box is a daily trading range. Each box resembles a day in the market. And here we can see it took 55 days for the daily ABCD to complete. 50 days for the daily ABCD to complete. And it took 43 days to go from the C to the D. Look how the market fulfills the ABCDs from the larger daily time frame, moving on a smaller 2-hour time frame, creating its daily trading range as it moves in the active zone and the dead zone. So there you can see how the market moves on the 2-hour chart as it moves from the C to the D on the daily. The market will not move in a straight line. It will always do what it does best, and that is wave from the C to the D. Here's another example. Each box is what the market did in a day. It took 37 days for the daily ABCD to complete. There's the A, B, C, D. And it took 17 days to move from the C to the D. Now, MTI traders are looking to trade on smaller time frames in the direction from the C to the D from a larger time frame, a push zone. So if you're a position or a swing trader, you prefer long-term positions, typically more than a day and possibly longer. You prefer to get in today and out tomorrow, next week, next month, or next year. Anticipate long-term profits, requires a whole lot of patience. Get in, stay in, and exit with large profits. In an uptrend, you are looking to capture the move from the C to the D. In a downtrend, you are looking to capture the move from the C to the D, the push zone. Right, larger time frames control the price movement and market direction on smaller time frames. There we go. So the black line here gives us the ABCD swing on the monthly chart. The blue line resembles the ABCD on a weekly chart. And the red over here, the red line, represents the ABCDs on a daily, and then the green represents the ABCDs on a 2-hour chart. And here's a nice example of the capital D extension being hit on several time frames at once. Right, the market hits the monthly D extension, it hits the weekly D extension, it hits the daily D extension as well as the 2-hour D extension. To give you an example, we recently saw this on the Euro New Zealand dollar. If we have a look at the monthly, there we go. Sorry, that wasn't the Euro New Zealand, it was the Euro Aussie. Euro Aussie. Just have a look at this most recent move here. Market hit the D extension, right? If we have a look at a weekly chart, Euro Aussie. And there we go, the market also hit a D extension. If we look at the Euro Aussie daily chart, then the market also hit a D extension. There we go, hit the previous D extension. And let me just see what we have on a 2-hour. Right, so the market was moving down. And there we go. This was the previous down AB boundary with that spike, but the market came down and hit the D extension. So on the Euro Aussie, recently before the market changed direction, the 2-hour hit a D extension, the daily hit a D extension, monthly hit a D extension, as well as the weekly. Not exactly to the pip, but we can see that the D extensions are hit at the same time. This would be the monthly D. There we go, monthly hit the D extension over there. And if I link that, you can see it hit the D extension on the weekly, hit the D extension on the daily, and also hit the D extension on the 2-hour. Veronica says, hi Tian, could you say why the push run is important in analysis? When you have, it's all about the direction of highest probability there, Veronica. And before we continue, before I explain that question, can we just get a Y or a yes, that we all are on the same page, where we can see on the Euro Aussie that the market more or less hit the D extension at the same time on the monthly and on all the other lower time frames. Okay, great stuff. Now, Veronica, when you have a bull market, for instance, in a bull market, you want to buy low and sell high. Buy, 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 and buy. In a bull market, you have higher lows and higher highs. You don't want to sell the peak, you just want to take profit. Buy, take profit at the high. 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 This will typically mean that you are trading from the C to the D. From the C to the D, from the C to the D, from the C to the D. Due to the fact that the direction of highest probability is bullish, percentage-wise, you have a better chance at making pips trading from the C to the D as opposed to selling in a bull market, because the market may just move up. Okay. If you trade in the direction of highest probability, if you trade from the C to the D, you have an opportunity to have consecutive winning trades rather than consecutive losing trades. Let me know if that answers your question. Right, so you trade from the C to the D, then you wait for the market to retrace, then you buy again, then you trade it from the C to the D, then you wait for the market to retrace, and then again you trade from the C to the D, and then you wait for the market to retrace. Okay, great question. Are we all on the same page here? Okay, beautiful, 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 beautiful. Right, now this is the end of the time frame lesson is by far the quickest lesson of all the UTP lessons. So I would like to turn to the live market and do a fresh top-down analysis to see how the higher time frames control the lower time frames. And type in your question section box a currency pair, and then we'll do an analysis on that one. I'll take the very first one that you type. Maria says pound US dollar. Andrew says pound, Maria says pound Australian dollar. Andrew says pound US dollar. Okay. Andrew, if there's time, after the pound Aussie, we can look at the pound US dollar. Let's do a new analysis on the pound Aussie. I'm just going to delete the current pound Aussie workspace. Open up a new one. Dale is saying the letter is signed invoking Article 50. Yes, that was signed yesterday, but it hasn't been sent yet, officially been sent. Right, pound Aussie, let's open up a monthly, weekly, daily and a 2-hour. There we go. Now, let's open up the monthly chart. First thing we need to do is just indicate the high and the low of the chart. There's the high and the low. Those will be major areas of support and resistance. There we go. Then I would like to have a look at just the most recent pivots. And we can see here that 1.6 figure was a round number, and it was also a level where the market U-turned in the past. When the market was below it, it acted as resistance, and when the market was above it, it acted as support. So it's a massive level where the market has got a history of U-turning. Right. Does that make sense? Before we carry on. So we can see here that the market has bounced at a massive level of support. Also, the market bounced, then gave us a beautiful bullish engulfing candle. And what happened recently is the market just came down again to test the lows of that candlestick formation, of that bullish engulfing candle over there. Right. To support this bullish bias that we have on the monthly is the stochastic is also bullish. Right. So there's a pivot. Then let's see if there's another pivot here. It seems like there's a pivot also at 1.7213, because that is a previous level of support where the market reacted, and then it bounced, and then it moved below it, and then we moved up and we bounced against that. Then it acted as resistance. So we know at that pivot at 7213 we will have resistance, and at this pivot at 1.6 figure we will have support. Right. So there we go. So now that I have the most recent pivots, let's have a look at trend lines here now. I'm just going to compress the chart, start my trend lines from the highest high, and I can see, wow, we have a downtrend line over here. We have another downtrend line over there, right? And we have another downtrend line over there. Quite interesting, right? So let's have a look at the Fibonacci's. So there's the down capital AB boundary on the monthly. Now on the monthly chart, we can see that we have an A at 2.7085. We have a B at 1.7326. And then the market retraced to the 50 retracement level. And that gave us our C high over there. And because the market broke the counter trend line on the monthly chart to the downside, we had confirmation that the market is indeed moving from the C to the D. And due to the fact that the market retraced to the 50 retracement level, the D extension is going to be the 1.618 at 1.1296. There we go. So that will be the D extension. That will be the monthly capital D. So we have a fairly good idea of where we are heading in the long run. Right. But also, the market doesn't move in a straight line. It's not going to move from the C to the D in a straight line. It will most probably wave. And we can follow the preceding wave movements to where we are at the moment. Have a look at this. High, low. Lower high, lower low. Now that we have bounced on massive support, we may be seeing a lower high and then a lower low again, and then a lower high and then a lower low again, and then a lower high and then a lower low until we hit the D extension. Right. So what I'd like to do is I want to focus on this down move that we have over here. This down move, the most recent move. This would be regarded as the most current trend because it resembles the move from the C to the D. There. This is the most current trend as it resembles the move from the capital C to the capital D. Right, would you agree that this is the most current trend? This outer trend line over there. That is the most current trend. I mean, this AB boundary commenced at the end of 2003. It's now 2017. This has already been in the making for the past 13 years or 14 years, right? Sorry, capital C to the capital D. Thank you, Andrew. All right, please pardon me. I'm also just a human being. Right. So the move from the C to the D resembles the most current trend. But what I'd like to say, to make mention that's very important on this monthly chart, is the fact that due to the fact that it's been taking 14 years for this ABCD, it may take another 14 years for the market to move from the C to the D. So it's just too large for us to use this as a context for looking at a trade on a daily and a 2-hour chart. Therefore, I want to focus on the most current trend from the C to the D. And because of that, I am now going to look at and focus on the sub ABCDs all the way from the C to the D. So I'm going to start my Fibonacci tool at the C of the capital or the capital C, and I am just going to remove the capital ABCD, the capital AB boundary. Right. I'll bear in mind that yes, the D extension, the capital D extension is at 1.1795, and we could be moving there in the distant future, and that is almost 5,000 pips away. But let's focus on the most current trend. Right, does it make sense so far? Focus on the sub ABCDs on the monthly. All right. So now we have an A at 2.2372. We have a B at 1.5788. Ask yourself, what zone are we in at the moment? In what zone are we in at the moment? Are we in a push zone? Are we in a retracement zone? Just focus on the sub AB boundary. Andrew says we're in a retracement zone. Dale says we're in a retracement zone. Okay. For those who are a little bit unsure, have a look at this picture. We have an A. There's the A. We have a B. After the B low was established, did the market break a down inner trend line, yes or no? Did it break the down inner trend line? Yes, it did. Second question, have we seen a substantial retracement? Yes or no? Have we seen the market retrace back inside the AB boundary into the sell zone, or the 382 or the 50 or the 618? No. No. So therefore, we are faced with a retracement zone. We are faced with a retracement zone. Does that make sense now? We are faced with a retracement zone. Immediately after this observation, we can assume that the direction of highest probability is bullish. This market will go up before it comes down again. It will most probably move up towards the outer trend line. It could even break the outer trend line, but it's going up until we either see a 382 or a 50, and then after that the market could bounce against the outer trend line and then start to make its move down towards the D extension. Only then will we have a down push zone again. Only then. And that bounce against the outer trend line must be confirmed with a counter trend line break. Then we will have a C high. So because we are still retracing from the B to the C, we have a retracement zone, and therefore the direction of highest probability is bullish. Andrew says, although the downtrend line break is not yet confirmed, the downtrend line break is confirmed. We'll see that on the lower time frames. Okay, it is actually confirmed. It is confirmed. On the monthly, it looks a little bit weird because the candles are spaced out. So it wants to touch the candlestick corner over here. It wants to touch that. All right. So It is a little bit confusing, but you'll see on the lower time frames that yes, it did break the counter trend line. Andrew says, can you talk about super shallows and the bounce of the 127 as well? Yes. In the event that the market gives us a super shallow retracement where it bounces against the 236 or even a shallow retracement at the 236 at the 382, then the market will most probably find massive support against the 127 extension over there, right? Then bounce and move up to give us a deep retracement, right? Like that. And once again, the bounce against the 127 extension has to be confirmed yet again with a trend line break like that. Okay, does that make sense? Good. Right, so let's remove all of this now. We have established, according to our analysis now, on the monthly chart, that we have support at 1.6 figure. We've broken a counter trend line, therefore we're heading towards the outer trend line, and that means we have a bullish probability, and also we have a retracement zone, and the next level of resistance will be that pivot at 1.7219. Right, and we actually have a nice confluence of resistance over here where the market forms a confluence with that resistance at where it converges with the outer trend line and this pivot at 7213. Now, let's go and have a look at the weekly chart. Let's go and see what we have on the weekly. Now what I'm going to do now is I'm just going to link those pivots. See if I can link the trend lines. Might as well just draw it again. This is the C of the monthly. We know that is the C of the monthly. So that's going to be the spot where I start my trend lines again. Outer trend line, inner trend line. Right? Oh wow, this is quite interesting. Why is that? Let me just open up a daily quickly. Ah, there we go. Okay, so you can see the market did break the inner trend line. So it's just, once again, the weekly doing the same thing as the monthly. I'm just going to start that trend line over there. So the market broke the inner trend line. We're heading towards the outer trend line. We have confirmed that we have a retracement zone on the monthly chart, right? We have a retracement zone on the monthly. That means we are going up. So tell me, which Fibonacci's would be the most important at this stage? The down fibs or the up fibs? Which ones? Which ones would be the most important? Aha. So to avoid any confusion, delete the down fibs and just focus on what we are seeing right now. Right now, the market is going up. We've confirmed that on the higher time frame. Remember, the higher time frames control the smaller time frames, and on the higher time frame we are going up. So I need to be looking at the weekly chart from a bullish perspective. So let's focus on this up AB boundary that we have here. So there we go. We have an A at 1.5788. We have a B at 1.7172. Then the market retraced and broke a counter trend line to the upside over here. That was the counter trend line that was broken. There we go. And that established a deep C. So now we have a C at the 8.6 retracement level. The market broke that counter trend line with a massive bullish engulfing candle. We have a stochastic that's bullish on the weekly. So everything is pointing to the upside. There we go. Now the D extension on the weekly will be the 1.18 extension. That will be over here at 1.7421. So that will be the D. A, B, C, D. And now we are heading from the C to the D. However, I have to acknowledge the fact that we will have resistance at this pivot at 7213 coming from the monthly. And then if the market can break that resistance, we'll be moving to the D extension. But from where we are at the moment, that is upside potential for 1,200 pips. There we go. Right. So the weekly has just confirmed our bullish probability. And now I'm going to look at this very same picture on the daily and the 2-hour chart. And I'm going to try and establish up ABCDs all the way to that D. Okay, does this make sense? Okay, I hear what you're saying, Andrew, but just park that thought for a moment. Okay, right. Okay, so we're heading from the C to the D. Now, let's go and have a look at the daily chart. There's the daily. Let's have a look at the trend lines. There's the outer trend line on the daily. Come on. There's the inner trend line on the daily. We can see, okay, the market broke that inner trend line. And remember, we have a retracement zone on the monthly chart, and we have an up push zone on the weekly because we're heading from the C to the D. So let's have a look at these up fibs over here. Because the bias is bullish, the directional bias probability is bullish, and see what we have on this daily chart. So now I can see we have an A, we have a B, the market gave us a deep retracement, a deep C, almost took out the A but didn't, deep C, and the market broke a counter trend line, and now we have a wonderful up push zone. There we go. And we are heading from the C to the D, and the D extension is going to be the 1.18 at 6907. Over there. That will be the D. And from where we are now, that is upside potential for about 686 pips. we can safely assume direction of highest probability is bullish. We have upside potential, 686 pips. The higher time frames are bullish. The daily chart is therefore bullish. And now I can start to time my trade. The very first thing I'm going to do is I'm going to look for an up sub AB boundary, because remember what I explained when we were on the weekly. I want to trade all these up ABCDs to the D extension, right? So let's look for an up sub AB boundary. And I'm going to start this at the C of the daily because we're going up. Look at that. We don't have a confirmed up AB boundary just yet because we don't have two candles to the right. So what I'm going to do now is I'm going to have to just draw a manual fib to illustrate what it will look like once that B high is confirmed. Do you agree that if everything stays like it is at the moment, the new up sub AB boundary would be looking like that? Okay, cool. Right, we're all on the same page. Now, we already moved below the 302, and we're most probably going to see a bit of a deeper retracement. Maybe the market will come back and bounce against the support at 1.6 figure again. And this leads me to believe that we have a crown. Left tip, center tip, right tip, crown. That means this up sub AB boundary, which by the way is not confirmed yet, may retrace to the 8.6 retracement level again. And that means the D extension will be the 1.18. Okay. Due to the fact that the stochastic is also bearish on the daily, even though we have a bullish probability, would you agree that the market is not at the perfect low price to look for a buy at this point in time? Do you think we should just wait a bit for that stochastic to turn bullish, for the market to establish the right tip of the crown, maybe for this one to break a counter trend line first, something like that? Wait for a counter trend line break. Like that. And then once the market has broken a counter trend line, and I have confirmation that we are moving from the C to the D with regards to the up sub AB boundary, then I can turn to the 2-hour chart and look for all those smaller up ABCDs and trade it all the way to the D extension. All right. There we go, guys. This is my explanation on time frames. Can you see how the higher time frames control the smaller time frames? Beautiful. Right, let me just save this workspace because now I deleted the previous one. Did you guys learn something today? This is now the end of our lesson. Unfortunately, we've run out of time. But did you learn something today? Good stuff. Good stuff. Right, thank you everybody for your participation. And I'll see you in the Analyst on Demand again in the next 15 minutes. Cheers!